Alibaba has gone up 75% since the start of this year, and they're often touted as the Amazon of China. So in this video, I want to go through their business, their moat, what they sell, what their offerings are, and then I want to look at their financials, do an in-depth review of their financials quarter over quarter, and see if I can pick out any trends there. And then I want to look at their news and sentiment around this stock and company, see what's happening, what are investors saying, if there's something we should look out for as potential investors in this company. And then finally, I want to round it out with a stock evaluation and valuation using my tool and see what the intrinsic and relative valuations look like potentially for this stock. So if you like this content, please stick around, like and subscribe, and then let's get straight into this. So Alibaba is a complex organization. They're now reporting in about 4 different segments. And so those include Alibaba China E-commerce Group, Alibaba International Digital Commerce Group, Cloud Intelligence Group, and all others. And so the Alibaba China E-commerce Group is things like domestic organizations and companies like Taobao, Tmall, Quick Commerce Solutions, and Wholesale, 1688. And these things serve the domestic consumers in China. And then they have a Alibaba International Digital Commerce Group. And this includes things like AliExpress, Trendyol, and Alibaba.com. And these are for international customers globally. These things are more of a competitor to Amazon.com. So Alibaba.com is a direct competitor to Amazon.com and other e-commerce platforms like that. And then you have Cloud Intelligence Group, which is focused on the cloud and AI and offerings in that space for global customers. And that is a direct competitor to AWS. And then you have all others, which is various other subsidiaries such as Know, DingTalk, Quark. And Know is especially important because they provide the logistics and the supply chain, managing supply chain platforms for a lot of the other e-commerce and commerce platforms that Alibaba has and offers. Now I want to look at their investment letter from the management, and I want to pick out things here that is very important to look at. So they report their fiscal year 2025 just ended. So they are now in fiscal year 2026. So it's a little bit of discrepancy in the fiscal year versus calendar year timing. But right now they've ended fiscal year 2025. So here they're saying that fiscal year 2025, they generated strong cash flows from their core businesses. They divested SunArt and InTime, which are non-core assets, and that enabled them to focus on their core businesses, which is the ones that I mentioned, especially those first 3 groups, and invest strategically in AI. So AI is the whole big thing right now for all big tech companies, and Alibaba is no different. They're going to focus on AI, and they're going to be focusing on cloud. So those 2 things and integrations of AI and cloud into all of their other services. Now, Joe Tsai is the chairman and Eddie Wu is the chief executive officer, the CEO. So here they say that over the next decade, AI will be the primary driver of incremental value and transformation. For Alibaba, this means developing world-class AI models, pushing the limits of model capabilities, and building a globally competitive AI-enabled cloud infrastructure. Together, these capabilities will position AI plus cloud as our key growth engine for the future. So when I read this, I see that they are completely refocusing on AI and cloud. They are competing with a lot of the big tech names. They're competing with Meta, they're competing with Google, they're competing with Amazon in making these AI models that are going to compete against Gemini, Anthropic, all these other AI models. So they're really taking the fight to US companies like that. And they said over the next decade. So this is not a short-term play in any stretch for any investor. It should not be a short-term play for any investor who decides to get into this name. Based on this, they have a long-term plan and strategy going forward. But just to give you an idea of how many places Alibaba competes, you can see this in this chart that I made. Tmall, online retail, competes with Amazon, eBay, Walmart. AliExpress, international business to customer e-commerce. Amazon Global, Wish. Alibaba Cloud, obviously AWS, Microsoft Azure. GCP. KNow, logistics and supply chain. FedEx, UPS, Amazon Logistics. Alipay, PayPal, Stripe, Square. Lazada, Amazon, C Group. Yoko is directly fighting against YouTube, Netflix, and Disney Plus. Alibaba Pictures Group, Walt Disney, Warner Brothers, Universal Pictures, AMAP, Google Maps, Apple Maps, Waze. It's insane how many different places that Alibaba is competing against with all these other competitors in different industries, different sectors across the globe. So now let's look at some business and financial highlights before we get into the straight numbers for their latest quarter that they reported. And so excluding SunArt and InTime, which I already explained that they have divested from their non-core assets, their total revenue increased from 2024 to 2025, their fiscal years, 10%. Alibaba China e-commerce group grew also 10%. Cloud Intelligence Group also grew 26%, and Alibaba International Digital Commerce Group, AIDC, increased 19%. And they say here, we undertook a strategic combination of Taobao and Tmall Group, Ele.me, and Fliggy into Alibaba China e-commerce group, transforming our value proposition into a comprehensive consumption platform. This is really important because they're re-architecting customer consumption offline and online. And they're making this into a comprehensive consumption platform. Cloud businesses delivered accelerated growth as a segment revenue and revenue from external customers both grew 26%. AI-related product revenue maintaining triple-digit growth. Their AI-related product revenue their growth is going crazy. And that's clear from all these other AI names that are posting also very high growth rates. And so they're saying that for the 8th consecutive quarter, that type of growth. That's pretty insane. I pulled it up, the earnings results. They've made $34.57 billion in revenue for this quarter. The income from operations came in at $4.88 billion. And then adjusted EBITDA came in at $6.384 billion. Adjusted EBITDA margin was 16%. Operating margin was 14%. And so we have net income coming in at $5.916 billion. And so this is a year-over-year change of 76%. Just high growth, very high growth. Net income attributable to ordinary shareholders, $6.01 billion. And so their diluted earnings per share came in at 31 cents. And that is an 82% increase year over year. And so we're looking at the yearly results here, year over year change. It's important to note these are ADS shares. So each ADS share represents 8 shares, 8 ordinary shares. Now we also have a look at their segmented results. So they segment them out for the investor. And so you can see here Alibaba China e-commerce group. They reported $12.459 billion, which is a change of 10%, like we saw in the investor presentation. Direct sales, logistics, and others, $4.093 billion, 7% change. Quick commerce, $2.064 billion, a 12% change. Then we have China Commerce Wholesale, $937 million, 13% change. Total for this group came in at $19.553 billion, which is a 10% change overall. So that is the majority of their revenue. That's the highest revenue generating segment. And that makes sense because e-commerce was their original business with Alibaba.com, and so which has been here since 1999. So it makes sense this is the highest revenue generating segment. And then they break down Alibaba International Digital Commerce Group. So here they're reporting a total of 4.85 billion, which is a 19% change like we saw. Cloud Intelligence Group, this is their Alibaba Cloud, 4.662 billion, 26%, even growing even higher than the other ones year over year. And finally, they have all others listed at $8.18 billion, which is a negative 28% return year over year. Consolidated revenue came in at 34.571 billion, and that is a year over year change of only 2%. But diluted earnings per ADS was $2.51. Now let's look at the cost and expenses to generate this revenue, what they were. And so here you can see that their cost of revenue in US was 19 billion roughly, which is 55.1% of their revenue, but also represents a 5% decrease of percentage of revenue year over year. So they're using less, they're getting more streamlined and reducing the expenses there, cost of revenue. Product development expenses came in at 2.94 billion. Sales and marketing expenses, 7.423 billion. General and administrative, 1.33 billion. And all of these are pretty much in check. Sales and marketing went up 8.1% year over year as a percentage of revenue. But general and administration went down 2.5% as a percentage of revenue year over year. Now, total cost and expenses came in at 29.708 billion. And then they also had share-based compensation expenses. And so what I wanted to see here was very small percentage of revenue, which it is, which is good. And so I would love to see it go down as a percentage of revenue year over year, but it pretty much stayed the same and went down a little bit, very little. But they're keeping that in check. And then costs and expenses, excluding share-based compensation expenses. Let's look at this. Cost of revenues, 18.981 billion, 54.9% of the revenue. And then you can see they broke all of these down. Moving down into their balance sheet, which is unaudited, by the way, all of these are unaudited. We can see that their current assets are 95.772 billion US. And of that, cash and cash equivalents constitutes about 25.563 billion. Is pretty good. They have that on hand. Total assets came in at $257.843 billion. Now moving on to liabilities, and current liabilities, total current liabilities came in at 66.116 billion. Total liabilities, $105.222 billion. So they definitely have more total assets, 257.84 billion versus total liabilities, which is 105.222 billion. Definitely good there, more than a double of total assets versus total liabilities. Total equity will be the combination of all of that together and should equal the total assets. So altogether, cash and cash equivalents restricted at the end of the period was $31.35 billion. And so all of that leads down to this last table here. And so they take the net cash provided by operating activities and then subtract the capex that they spent. And they actually had a negative free cash flow for the 3 months ended June 30th, 2025. Okay, so now I want to go into 3 news articles about Alibaba. And so the first one, we're seeing that analysts are upgrading and re-rating their stock prices on Alibaba. And here you can see in this Yahoo Finance article that analysts are looking at Gen AI, generative AI tailwinds to bolster Alibaba's stock and company going forward. So they raised the price target to 195 per share from 176. And so they noted that even though they missed, you saw through the presentation and the numbers from the financials that they missed the first quarter fiscal 2026 headline consensus expectations, and that's due to the partially accounted for the asset divestitures, SunArt and InTime, increased investment in quick commerce, their quick commerce segment in the e-commerce overall segment. And that pressured margins. You can see how they were negative free cash flow. That was all due to reinvestment and investment into their business, kind of like Amazon's model. But they note that Alibaba's cloud and e-commerce segments are gaining strength, while cloud is delivering a solid beat and guidance pointing toward further acceleration. And these aspects reinforce the company's position as a leading Gen AI and cloud infrastructure provider. So they are really focused on not the short-term ROI for investors. This is a long-term play, like I said. And so looking forward into years into the future, they're really positioning themselves for AI dominance, cloud dominance, and they're investing right now to capture that future that they see. So yeah, you can't look at this company right now and be like, oh, it's showing weakness here, weakness there. It is, but it's very intentional. It's intentional weakness that they're doing, intentional investment that they're doing to get this company to where it needs to go. And I think you will see more and more analysts that are covering the stock, cover the stock, one, and then also re-rate their price targets, their expectations for Alibaba going forward when these investments have really taken hold on Alibaba's top line and bottom line. You will see these analysts come in. They're going to come in after the fact, after all of this has come through, and then they're going to re-rate. That's how it always works. So the next article I want to look at is showing that Alibaba has always had a T-head department where they were building their own chips, but now they're trying to build these custom AI chips to break their NVIDIA dependency. So you know how in the news lately there's been issues between China and the US due to chip restrictions. But what Alibaba is doing now is they're putting more investment into building custom AI chips to break their NVIDIA dependency. So this is a really, really interesting thing, and it could be a game changer for Alibaba and what they do and what they offer to other companies as well in China and maybe even outside of China. So here they're saying that they are developing inference chips amid US tensions, planning a $53 billion AI push. They've developed custom AI inference chips to reduce reliance on NVIDIA. They're committing $53.1 billion to AI development over the next 3 years. This goes into the CapEx and the reinvestment into their companies and businesses and subsidiaries. That's why their ROIs are reduced right now, but it is all for a long-term vision. Chip targets inference rather than training, part of a broader Chinese semiconductor independent strategy. And so they'll also get political goodwill with the Chinese government with this. They're targeting their policies to also ingratiate themselves with the Chinese government, which can only help them in doing this, because this will be seen as a nationalistic push into making China's own chips or intensifying China's own chip production. Move reflects intensifying chip war as Chinese tech giants develop homegrown alternatives to US technology. Finally, I want to look at another article that I found about China's food delivery wars. And so here we're comparing Meituan, which is a competitor in the food delivery space, JD.com, also another competitor, and Alibaba and their quick commerce solutions, subsidiaries like that. The key points here are that Alibaba's already number one in food delivery orders. They racked up 120 million orders very quickly, and they were able to handle that because they reinvested all this capital, or invested all this capital in building up LME's underlying infrastructure. So they could handle that type of scale up. And it directly boosted Taobao's daily active users by 20%. This investment has led to a few trends, and this article points them out. The integration of food delivery services directly into the Taobao app has pushed Taobao's daily active users, DAUs, past those of PDD, Pinduoduo. That's one. And you can see it in this chart here that Pinduoduo is now lagging behind Taobao's DAUs. And that's really important because that's the source of the orders, basically. And then the second trend here is Alibaba is rapidly expanding their delivery rider system. And here, Meituan's rider base was nearly 8 times the size of Alibaba's prior to the delivery subsidy war. That gap has now narrowed significantly to just 2.6 times. They're doing incredible growth in this space, Alibaba and Taobao. So lastly, I wanted to look at the valuation of Alibaba. So I pulled up Alibaba in the stock valuation tool. You'll see that it's been converted to USD, all the numbers. And let's go down to the company comparative analysis. And the trailing 12-month PE is 15.7, 4P is 17.7, price to book 2.3, PS ratio 0.3, PEG is 1.5x, PEGI is 1.4x because they obviously issue a dividend. And so these are very good numbers right here. It would be even better if they were below 1, but close to 1, a little bit above 1 is still pretty good. Let's compare this to Amazon and look at some of the revenue growth and EPS growth as well. So here you can see that Amazon's trailing 12-month PE is 35 and 4P is 29.9. And so I'm using Amazon because that's one of the most direct comparisons to a company like Alibaba, which has its hand and foot in everything. But you can see what the difference is, and there's a huge difference, less than half here for their trailing 12-month PE and 4P. Well, 4P is a little bit more than half. If we go up to the multiple of earnings valuation, we can see that analysts are going to start re-rating the multiple, the PE ratio for this company. And if it can go closer to maybe a 20 PE, or higher, which it should be trading at instead of a 15, around 15 or 17 PE right now, the numbers, the multiple of earnings valuations are closer to 200 plus. This is not a short-term investment. This is a long-term investment. And that's it, guys. That's my analysis of Alibaba. What I'm doing right now is I have started a tracker position in Alibaba, about $500. And so going forward, I'm going to DCA as I see short-term dips, trying to get a concentrated position in Alibaba so I can hold it for 2, 5, 10 years. It's going to be a long-term position. Obviously, all of my positions are long-term. I don't plan to sell any of them anytime soon unless something materially changes in the fundamental analysis or the moat is eroded somehow. But this is going to be a long-term investment for years and years and years. And so I'm just going to build up that investment. If you like this content, please like and subscribe, and I'll see you guys in the next one.